Accounting and Auditing Committee of BCS till 2019-20. He is compiler of the column from published accounts appearing monthly in BCA journal since more than 25 years. He has delivered lectures at various seminars, conferences, presented papers and written articles for ICI, BCAS, CTC, IFSC, etc. on subject of accounting standards, auditing, etc. He has also conducted training of CAG and corporates. He is director and member of audit committee of various companies. With this, I hand over proceeding to Sri Himanshu Ji for.
Thank you, Vishnu. And I request the delegates to have, if they have any query, they can put it in the chat box, or they should read at the end of the session. And now I request Himanshu sir to start his presentation.
Yeah, good evening. You can hear my voice?
Yeah, sir. सर मेरी थोड़ी बहुत क्वेरीज है, अगर आप चाहो तो क्या इन बिटवीन जो आपका प्रेजेंटेशन
होगा, you put it on the chat box. You put it on the chat box.
Okay, sir. I will put it on the chat box.
So, good evening to all of you, and this is a presentation on the changes in Schedule 3 and CARO 2020, which are applicable for 31st March 22 reporting. So, I'll put on that presentation which is there. So can you all see the presentation?
Yes, sir.
This is the presentation which we are going to do today. Changes in Schedule 3 and CARO 2020 which are there. To start with, you have this section 129 of the Companies Act, which says that the financial statement should give a true and fair view and should comply with all accounting standards which are notified, and it should be in the manner provided in Schedule 3. Now, besides section 129, the companies also need to disclose various items which are in other statutes. So, to just summarize here on the first slide itself, there are financial statements who need to comply with formats as per Schedule 3, Division 1, 2, or 3 as applicable. The disclosures of notified accounting standards, which would be Ind AS or the normal AS. There would be other disclosures, say like other sections of Companies Act, like say section 185 or 186(4), which wants you some disclosures. There are other disclosures also for MSME Act, which are there. For listed companies, SEBI, LODR also want certain disclosures. And if you are an NBFC, whether listed or non-listed, again, there are several disclosures which are required in the financial statements. So Schedule 3 is just one requirement. There are a lot of other requirements also. And in this presentation, we are going to deal with Division 2 changes, which is really applicable to Ind AS companies. But most of these changes are also applicable to Division 1 companies or Division 3 companies, which are NBFCs. Division 1 is non-Ind AS companies. So Schedule 3 was amended on 24th March 21 last year. And the changes were effective from 1st April 21, which means for financial year 21-22. But you also need to give comparable figures for financial year 2021. So whatever are the new disclosures, you will also need to give comparable figures for the last year. Now, since auditor is required to give a true and fair view, the additional disclosures will also be covered by the auditor's report. So the auditor also will comment whether those disclosures are true and fair. And the institute, after a long time, after giving a lot of time for discussion and all, came out with this guidance note in January 22 for all Division 1, Division 2, and Division 3 of Schedule 3 to the Companies Act. And this is very important to be followed by the companies and the auditors when they are preparing their financial statements using this revised Schedule 3, which is there in that sense. Now, when you come to audit reporting, the audit reporting is in the Companies Act, which is under section 143 of the Companies Act. And there are the subsections 1 to 15, which tell you what are the reporting requirements. Out of these requirements, you have got section 143(11), which tells you about this CARO reporting, which is there. So CARO is part of that section 143 reporting, wherein the section 143(11) tells you what additional matters have to be reported in a separate statement, which is there as such. So that is CARO 2020, which we will also deal simultaneously. Now, 143 only tells you what is to be reported in the format which is to be reported. That is always given by the standards of auditing which are there, which would be your SA 700, 705, 706, and so on. When you come to CARO 2020, it applies to every company, including a foreign company, except companies which are registered under Section 8, a one-person company, which is as per Section 185, and there the turnover is 2 crores, turnover is 20 crores, and the capital is 2 crores. So that is the limit for a small company, which was amended just last year. And private limited companies, it does not apply if you are not a holding or a subsidiary company with a paid up capital of not more than 1 crore, borrowing not more than 1 crore, and turnover not more than 10 crores, which is there. The paid up capital is at the year end. The borrowings and all are at any point in time, and the turnover clearly is a cumulative turnover of 10 crores. So if you are a small company and a private limited company, but if you are a small company with that 2 crores capital and 20 crores turnover, the exemption would still apply, because small company exemption will be looked simultaneously along with the exemption of the private limited company. When you come to this private limited company definitions, the reserves are in line with Schedule 3. If you are under Ind AS, will also include the balance in OCI for MTM changes and so on. Borrowings, you have to look at both devolved and non-devolved borrowings. So if they are devolved, even the non-fund credit limits are to be included. Borrowings are to be looked at any point in time. So if I have borrowed and repaid during the year, CARO may still be applicable to me. And revenues would also include other income. In case you believe CARO is not applicable to you because you are a small company or you are satisfying the conditions of a private company, you need to write very clearly in your main audit report that CARO is not applicable because of following reasons or something. So that is just the basic introduction as to when CARO applies. Now, when you come to this Ind AS balance sheet format, and this is how the Ind AS balance sheet format looks like. Start with non-current assets, and wherever this is given in red, there are changes which are done by the Schedule 3, which is there. So if you see asset side, literally a lot of changes which are done on the asset side of this balance sheet by the Schedule 3 for changes. This is again the same format carrying forward. So changes in trade receivables, loans. So this is only in summary form. What are the changes carried out? We will see in detail each one of these changes which are there. So again, in current assets, for trade receivables, for loans, there are changes. When you go to the liability side, in equity capital, there are changes. In financial liabilities, there are changes. Trade payables, again, there are changes. Borrowings, there are changes, and so on in current liabilities also.
Sir, one thing, sir, so far as whatever changes are there in this, Division 2, I think most of the changes are the same, requirements are same in Division 1 also.
Yes, that's right. That's right. Except maybe whatever is Ind AS related, like ECL and other things.
Yeah. Thank you.
So this is just a brief summary about what is the Schedule 3, which changes in a nutshell what they are. What is CARO 2020, which is there. Now we can really go on to each one of the change, each of the item which was listed here. What are those changes which are there one by one, and wherever there is a corresponding reporting under CARO, it is covered at the same place, so that both are linked in that sense. So CARO we will not cover separately. It is taken at the same time wherever these changes have come in that sense. So one of the first changes is, and what you will see is whatever is given on the top is currently what is there, and as per the amendment what is there. So everywhere it will be given like this: what is currently there in Schedule 3, what is the change which has come in. So on title deeds, currently no disclosures were required. However, there was this CARO 16 which required only auditors to comment on whether title deeds are in the name of the company. Now, as per the amendment, the company has to provide details of all immovable properties other when the company is a lessee, and all lease agreements were duly executed in name of lessee. If title deeds are not in the name of the company, and there is a format which is given by the schedule, which we will see on the next slide. If it is jointly owned by someone else, the details are also required to be given as to what is your company's share in that joint immovable property which you are holding. So this is the format in which you have to give title deeds not in the name of the company. So you have got property, plant, equipment, could be land and building, it could be investment property, it could be PP retired from active use and so on. So description of the property, gross carrying value, title deeds held in the name of whom, whether the title deed is the promoter or a director, you have to write there, whether on that name it is held since which date and the reason for which the property is not in the name of the company. Now, a lot of information is given here in this case. You will see later on that CARO also needs to give all this information. Till last year, it was only CARO. Now, this year, it is Schedule 3 as well as CARO. Both you are going to give this particular information. Now, if it is held by a relative or a promoter, the definitions are the same as given in the Companies Act. You also need to write if there is a property not transferred because it is in dispute or something. So that also can be a reason which you will need to write. So here only immovable property is covered, which is under non-current assets. So if you are holding something in inventory, so say a real estate developer, a builder is holding immovable property and which is not in his name, but because he is holding it as an inventory, this disclosure will not be applicable. And as you know, a lot of builders don't hold property in their name. It is always held in the other person's name and finally transferred to a society, or the conveyance is done to a society. They only hold the power of attorney from the landowner to the final property to the society. But this reporting requirement is not covered if it is held as inventory. So builders or real estate developers need not disclose this if it is held as inventory. If you are only putting this immovable property in the fixed asset or property, plant, equipment schedule or investment property, only then this disclosure applies. Title deeds would mean legal deeds or documents which constitute evidence of right to the legal ownership. For leased assets, it would be lease agreements or related documents. It would also cover other immovable properties which cannot be covered here if it is in others. If you have a flat in a cooperative society which is in the name of a director, that also need not be covered. That will be covered here, and you'll have to say that it is in the name of a director. If it is not held in the name of a company due to a dispute, give full details of the dispute which is there. When you come to this property, plant, equipment, there are some other changes also on account of this revaluation if it has been carried out. So currently there is no requirement of how this is to be disclosed, but now there is a disclosure that if a company has revalued its property, plant, equipment, including its right of use assets or intangible assets, the company has to disclose whether the revaluation is based on a registered valuer report or it is just carried out by some internal valuation done by the company. So earlier there was no such requirement, but now if a company does a revaluation, you need to write how have you done the revaluation, whether it is by a registered valuer or are you using only the stamp duty valuation or whatever. When you come to CARO, there are clearly some changes which are there. So on the left hand side is the requirement of the old CARO, which is CARO 2016. On the right hand side, you have got the new requirement. One of the first requirement is instead of fixed asset, they are calling it property, plant, equipment. That is a change because nowhere now we call it fixed asset. It is called property, plant, equipment. The other change is that earlier it was only property, plant, equipment. So tangible assets are registered needed to be maintained. Now the CARO 2020 says that whether the company is maintaining proper records showing full particulars of intangible assets. So if you have software, if you have got licenses, if you have got some copyrights, all that also you have to now enter in a fixed asset register, because in CARO you need to now write whether intangible asset register is also maintained by the company. So in intangible assets, also you will need to give a lot of information, and even for tangible assets, you need to give a lot of information which is there. And typically in a fixed asset register, whether it is tangible or intangible, You have to give all this 17 items which are there, because there would be registers which may not have all this information, but all this information which will need to be given in the case of a fixed asset register, both tangible as well as intangible, which is there. If you come to the same PPE clause in CARO, on clause 3(1)(b), there is no change, whether the assets have been physically verified and whether any material discrepancies have been noticed. No change in this clause. When you come to the third clause under CARO is again on title deeds, and we saw that in Schedule 3 there is a change on title deeds which was there, and here also it is now clearly asking little more whether title deeds of all immovable properties other than where you are the lesser lessee disclosed in the financial statements are in the name of the company. If not, provide the details. Now, if you see the details here, and if you see the details in, if you see the table earlier which was there, the table is more or less similar.
प्रॉब्लम है. He's joined now.
तुम लल्ले को तेरे फोन बुला मेरे फोन तो बंद लगे वो बात में भाई मैं इसको राजेश को बोला सही दर्द हो
Hello, can you all hear? I think the connection got.
तो हाँ सही हो
Hello.
Please keep themselves muted because lots of noise is going on.
Yeah, can you hear?
Yes, sir, we can hear you.
Sorry, I think there was some connection lost.
Yeah.
So we were at this particular slide.
This we had covered.
Yeah, so this we covered. So come to this property plant equipment, there are changes which were done in Schedule 3. There are changes which are done in CARO. There is one more reporting in CARO, a new clause which is added for this revaluation. Now we saw that in Schedule 3, there is a change which says that in case you are doing a revaluation, whether it is done by a registered valuer, and if not, how have you done it? In CARO also, you have to report that if you have done a revaluation, which is more than 10%, then you will have to write whether that plus or minus 10%, and if so, whether it is done by a registered valuer. Again, there is a lot of linkage with what you report in the financial statements. So these are the changes which are really happening in property plant equipment. So what we can do is on this property plant equipment, in case there are any queries, we can take them at this stage itself rather than wait for another clause or something in that sense. So in case there are any queries, we can take those changes at this place itself.
Yes, sir. Sir, I have written one query in the chat box. In case the change in the name of the company, but the title deed is an old name itself, then whether it has to be reported.
It will need to be reported, and you will have to say that they are in the old name. Otherwise, it will need to be reported.
It need to be reported. No? And one more thing,
Yes.
in under this property, plant and equipment in the balance sheet, we have to give the requirement of reconciliation is there. There they are saying that you need to give a reconciliation statement of gross carrying value and all this thing. So whether
Correct.
how it is different from the old requirements, sir?
There is no
Because
change in that. That is the same. The reconciliation is the same. There is
same.
no change there. Yeah,
So why
that
they
is
have
same.
given this time? This need to be given.
No, they are only making it more specific, no? That you also give a reconciliation of the gross block, net block from the opening, closing, and so on. They're making it only more specific. That's all.
But there is no change. No?
There is
Thank
no change in that.
you.
Okay. So this is really the changes in property, plant, equipment, and lot of balance sheets have already come, and you can see what is being reported in the new balance sheets which have come. Lot of manufacturing companies, lot of IT sector companies have also given their new balance sheets, which covers these new formats which are there of property, plant, equipment uh, in their financial statements.
So there is one more query in the chat box. If property is in the name of the company only, then also whether this chart has to be given. I don't think this chart is to be given.
No, if it is only not in the name of the, but you'll have to
Then
give a note there that there are no properties which are not held in the name of the company. That note will have to be given there.
that should be given the CARO report. No?
Yes, in the below the PPE schedule, then you say that all properties are in the name of the company. No,
This
no
should be
need to give
given.
the chart then.
This should be given in the balance sheet also.
Yes, yes, yes. Otherwise, the registrar of companies may say that you have not given this information.
Okay.
So therefore, it is better to say that yes, we have given the information, but everything is in the name of the company itself.
Okay, sir.
So let's go on further. The next is on this capital work in progress, which comes after property, plant, equipment. And the amendment is that for capital work in progress or intangible assets under development, you also give a aging analysis. So you have to give for project under progress and projects temporarily suspended for CWIP or intangible assets under development, less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. So far, we were only giving a total figure, but now you will have to give this aging analysis of capital work in progress, what progress are currently going on, and in case any project is temporarily suspended, you will have to give that information of what are the projects temporarily suspended. There is something further also which needs to be given, that in case there is a project which is overshot or temporarily suspended, but it has exceeded its cost or exceeded its time, then you have to give project 1, project 2, and so on. And there you have to give the name of the project also, and whether it will be completed in less than 1 year, 1 to 2 years, and so on. So in CWIP, lot of information needs to be given. Earlier, it was only one figure, but now since lot of information is to be given, there is a lot of information available to the auditors also, and also available to the investors, because if you write that your project is now more than 3 years delayed, there would also be a question of whether the project will really start, whether I need to do an impairment on that particular project, and so on. And it will also give a lot of information to your other competitors as to what projects you are currently doing, because if there is a delay, you have to give the name of the project also, why that what is that project and why that project has been delayed as such, and up to what period will you complete that particular project which is there. And we will have to see balance sheets of bigger companies as to why or how this disclosure is given. But from the balance sheets which have come so far, this information is given in a quite transparent manner as to why the projects are delayed, and so on, which is there as such. So how do you really decide what is a project? So I will have to look at the internal MIS of a company, and project typically would mean the first date when the project is internally started. So the management will have to decide what is the internal date when the project has started. Aging will have to come from that particular date which is there. If there is a temporary suspension, it may not get reported, because if it is part of the process, say like a rainy season where you cannot do construction work, that is a normal part of the delay, and it cannot be called a suspension in that sense. You need to give a disclosure in both cases if the project is within cost, but the time is overdue. The time is not overdue, but the project has exceeded cost. Both ways, whether there is a time overrun, both ways you have to give details of the project. Original plan versus revised plans and other relevant management judgment would be required for this. And if there are a lot of projects which are there, you can aggregate some of the projects if they are individually not material. So if you have got a big company who has got projects of 5,000, 10,000 crores, you may not give names of each project, but you can aggregate or combine some of the projects while giving disclosure under this particular clause. But a very new disclosure, which will require to be given by almost all companies, and this also includes intangible assets under development. So if you are implementing a SAP or any ERP, or if you have got some licenses which are in progress or registrations which are under development, then all that information will also need to be given because this covers both tangible assets as well as intangible assets which are under development, which is there.
Sir, in case if some plant and machinery is under installation, running factory, some plant and machinery addition has to be there and that are under implementation, then whether this has to be given also in those cases?
Yes, it will, because it is CWIP. Whatever,
is
if you give in the balance sheet in CWIP, then the aging has to be given.
Has to.
So this is how the columns need to be given. CWIP, intangible assets under development, projects in progress, projects temporarily suspended. Only if the delay is on account of cost overrun or a time overrun, only then the name is to be given. Otherwise, if you don't give the name for normal projects, then it is all right. But the aging will still need to be given for all your CWIP for tangible assets and all intangible assets under development. If you go on further to investment property, which is in the balance sheet, earlier there was no disclosure whether about the fair value or anything, but now companies have to disclose whether there is a fair value of investment property, whether it is based on a valuation by a registered valuer, and it therefore integrates the requirement of both Schedule 3 as well as Ind AS 40, because Ind AS 40 also had that same information which needs to be given. How is the investment property fair value determined in the disclosures which are there as such. So the same disclosure will be given now for all balance sheets also. Okay, so that completes your property, plant, equipment, CWIP, and your investment property. We then come to this trade receivables, and this is the current requirement for trade receivables which is there. Currently, we are giving 4 things considered good, secured, unsecured, trade receivables which have a significant increase in credit risk, and receivables which are credit impaired. An allowance for bad and doubtful debts is to be disclosed. Debts due by directors, etc. is to be disclosed. This is currently the requirement of Schedule 3. The new requirement is now telling you that give this information under 6 different buckets which are there. If you go to normal AS or division 1, this ECL will not be required. But if it is an Ind AS company, you will require all these 6 disclosures which are there, and this aging less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 and 3 years or more. And outstanding for following periods from the due date of payment. Now, due date of payment is as mentioned in your invoice. And if there is no due date mentioned in your invoice, it will be from the date of the transaction which is there. So you have got undisputed trade receivables considered good, undisputed receivables which have a significant increase in credit risk, credit impaired, whether disputed considered good, disputed with the increase in risk, and disputed which are credit impaired. So 6 categories to be given under 5 different buckets, and the total of course will tally with your trade receivable figure which is there. So all your systems will need to be modified, because this information is also to be given for the last year, not only for 22 but also for last year it needs to be given. You may also need to add a column for unbilled revenue. Only then your total will tally with your trade receivables figure which is there. And for all Ind AS companies, you will also be doing expected credit loss provisioning as per 109. So as per 109, you have to decide whether this is a general approach you follow for ECL provisioning or a simplified approach or the purchase or originated credit impaired approach which is there. And that disclosure also needs to be given, because if there are any bad or doubtful debts, you will have to give this as a separate disclosure as a deduction from one of these items which are there, especially if you have credit impaired and significant increase, both disputed and undisputed. You will have to make a provision for ECL in terms of this Ind AS 109, the provision for ECL based on either general approach, simplified approach, or this purchased or originated credit impaired approach which is there.
Sir, as an auditor, one question, as an
Yeah.
auditor, how do you ascertain and how do you rely on the client's version that these data
So
has
you will have to see
these
the system, no? You have to see the system, no? Whether the system gives you all that information, and maybe you have to do a systems audit also if required.
because it's a huge responsibility, sir.
It is a responsibility, but if you are doing an audit and signing something, obviously you have to take the responsibility. Because the responsibility definitely comes because all this information you are validating now, because it is now part of the financial statements, and not only do for this year, even last year's information will be given, and you'll have to look at the system, whether the system is reliable, whether the data is entered properly, and therefore we either do an IT audit, or if it's a large company, we tell the internal auditors to do a review and then validate all this information which is there. So moving on further, on security deposits, earlier security deposit was to be given under loans. Now it is to be disclosed under other financial asset. This is just a disclosure change which has come in. On loans and advances, there are a lot of disclosures which have come, and they are also linked with the CARO disclosures which are there in that sense. So this is the current requirement. Loans due by directors, advance to directors, and as per Ind AS 24, if it is to related parties or something. As per the amendment, we have to give disclosure whether any loans or advances in the nature of loans are given to promoters, directors, KMPs, or related parties, either severally or jointly, which are repayable on demand or without specifying any terms or period of repayment. So if I have given a loan or an advance in the nature of loan, either to promoters, directors, KMPs, or related parties, I need to give it here. And what is that percentage to the total loans and advances which I have given? Now, again, this information has to be given for both years, and the amount has to be given at a gross level without netting any impairment or doubtful debts which could be there as such. Now, this information is very important because if it is repayable on demand without any or without any terms or something, there could be a lot of other implications, like say in income tax, whether your company law compliances are there or not there. All those implications will also come in when this disclosure is given directly in the balance sheet in the notes to accounts itself. Then there is an amendment on account of utilization of borrowed funds and share premium. So if the company has advanced or loaned or invested funds, you have to give all these things about the ultimate beneficiary. So basically, if I have advanced loans to someone and that someone is also repaying something with the indirect instruction that the money will come back to me, then you will have to give all this information. And as you know, there is also a separate reporting under your main audit report on this particular aspect also, that rule 11 which is there, which we will cover towards the end of this particular presentation. So this is a new requirement, and in this requirement, schedule also says, and the guidance note also says that you give all these details and also give declarations about whether you are complying with FEMA, whether you are not violating the Prevention of Money Laundering Act and so on. All that information is directly given as a confirmation in the financial statements. Now this is when I give loans to someone with a circular reference that the money will come back to me. This is the reverse of it. If I have received any funds in such a manner that I have to in turn give it to someone else so that he can repay loans and regularize his account. So this is for funds given for circular transfer of money. and what we normally call it as evergreening of loans. So if you are giving any loans or receiving any loans for evergreening of the loan of some other party, the details needs to be given in the financial statement that you have given a loan to someone with a view that he can repay his other loans or something. Or if I have received money, I have received money so that I can give it to someone else to be able to regularize his loan or some other thing. And in all these things, whether you are compliant with FEMA, whether you are compliant with Companies Act, whether you are compliant with the PMLA or Prevention of Money Laundering Act also needs to be clearly mentioned in the notes to accounts. When you come to CARO reporting, this CARO clause 3 has a lot of sub clauses where all this reporting now comes in. So the first clause under CARO 3A is whether during the year the company has given investments or provided guarantee to anyone who is mentioned here. So whether during the year company has provided loans or given guarantee to any other entity, if so indicate the aggregate amount given, whether it is to subsidiaries, joint ventures, associates, or any other party other than subsidiaries or joint ventures. So here, luckily, what is talked about is only loans given during the year. If it is given in the earlier year and only the balance is carried forward under this CARO clause, you don't need to report uh, whether loan was earlier there and it is still continuing or something. So loans will include both long-term and short-term, whether given in cash or in kind, and includes even loans which are squared up. Whether advance is in the nature of loan depends on the circumstances of the case. Information is for all parties and all kinds of loans. Even an employee loan will need to be covered here. A separate register is to be kept by the company for all such loans. Subsidiary associates are as given by the definition of the Companies Act. And if you have got such loans, you as auditors, we may even need to confirm compliance with 179, 180, 85, 186, and 187. This clause is, however, not applicable to companies whose principal business is to give loans. So if it's an NBFC, this clause is not applicable because you cannot report in an NBFC because the main business of the NBFC is to give out loans in that sense. So for NBFC, this clause is not applicable. For all other entities, this clause is directly applicable. And this is the format which is suggested. Now, this is the format in the CARO report. Again, this is very similar to the format in the Schedule 3. Again, you can integrate the two formats and cross-refer or refer from the auditor's report to the table which is given in the financial statements. So aggregate amount given to subsidiaries, JVs, associates, others, and what is the balance outstanding on the balance sheet date. Now, others will include everything, even loan to employees will be included in that others which is there. The second clause on these loans, and we are covering all loans together. We first saw the changes in the loan reporting in the Schedule 3. Now we are looking at the changes in the loan reporting for CARO 2020. So the second clause in this loan is whether investments made, guarantees provided are not prejudicial to the and the terms of the conditions are not prejudicial to the company's interest. Now earlier it was a restricted reporting, but now it is covering all your loans also and investments also. So in addition to loan, even investment is covered here, and it is saying that it is not prejudicial to the company's interest. So you need to evaluate all your conditions. So if you have invested in a private limited company where you know the net worth of the company is only 100, but you have invested at a premium of 500, then you'll have to say whether it is prejudicial or not prejudicial. And this, as you recollect, has a lot of genesis in the income tax investigations which happen. That in income tax, the investigation found that one person or one company is investing in another company at a very high premium, though the other company did not have any net worth or anything. Now, if that is so, in addition to income tax questioning you, now the auditors also will need to report whether if there is any investment made, whether that investment is prejudicial or not prejudicial to the interest of the company as such. So if I'm making investment in the company at a very high premium and that premium cannot be justified, even before the income tax can question you and find it out, the auditor will also have to report whether that investment is prejudicial to the interests of the company or not. Loans,
Yes,
in
sir.
any case, loans were also covered earlier, but investments are also sought to be covered now. Let me complete
But-
clause 3 on these loans and then we can take a
Okay.
question. The third clause in this loan is in respect of loans and advances, whether the schedule of repayment and principal is regular, has been stipulated, and whether repayments are regular. So again, you'll have to give your name of entity, amount, what is the due date, extent of delay, and remarks. Now, this is also applicable to NBFCs. There is no exemption for NBFCs on this, and in an NBFC, this can become a very big table because you can have hundreds of parties who are there. But in practice, what is found is the categories of the lenders are given here. Say you can give all housing loan entities or housing loan applicants. You can have vehicle loan applicants, and you can aggregate those things when you are reporting under this clause for a NBFC. But this is a one more new clause which has come in that sense. Then if there is any amount overdue, then also write what is overdue for more than 90 days. This was also there earlier, but now it is linked with the earlier reporting also. So in that sense, it becomes more stringent, more strict to report on this particular clause also. Then this is a new thing, whether any loan or advance in the nature of loan granted which has fallen due during the year has been renewed or extended to settle overdues of other loans given to same parties. We saw in schedule 3 that this reporting has come. As auditor also, we are now supposed to report whether you are granting any loan to someone to repay some other loan which is there in that sense. This clause not applicable to companies who are in principal business of giving loans, so to NBFCs. But even for all other entities, this particular reporting is applicable. So if you have given a loan or some advance with a view to renew or extend your existing loan, then this will trigger reporting under this particular clause. And the last clause is that if you have granted loans or advances repayable on demand or without any terms of payment, especially if they are granted to promoters, related parties defined in 276. So if I have given any loan to a promoter or anyone else in that sense, if this is repayable on demand or without specifying any terms or period of repayment, I will need to report under this particular clause. Earlier, no such reporting was there. And you can imagine that if you report such things, in income tax, you can easily get all this information. The assessing officer can get information that you are giving so many loans which are repayable on demand or which may be without interest or something. And they may say that we will not allow you to interest on the interest paid if this money is out of borrowed funds in that sense. This is the table in which you need to report all this. All parties, promoters and related parties, aggregate amounts repayable on demand or no term specified, and as compared and compare this with the total of the loans which are given by the entity which is there. Clause 4, there is no change in loans and advances. So it remains as it is. We can now take these queries on loans and advances both from Schedule 3 perspective or from this CARO reporting perspective.
Sir, I have one query. In the very first clause where you said that the investments, the auditor has to report whether the investments made by the company is not prejudicial. So
Correct.
where the companies are making investments in the private equity.
Yeah.
So again, the lot of valuation comes into the picture because those private equities are based on the valuation because they, to the unlisted companies, there are always high premium attached to it.
So you'll have to
There may be
justify, the company will have to justify to you whether it is properly paid or not paid. Otherwise, you may have to say that we are not in a position to find out whether it is prejudicial or not. Otherwise, you will have to give your opinion whether it is proper, fair valued or not.
okay. So you have to rely on the other party's valuation report. That is a
Yeah, and you will have to also make your own judgment, no, whether that report which they are giving is proper or not proper. If not proper, you will have to say it is prejudicial. Otherwise, you may have to say we are not able to comment whether it is prejudicial or not.
And where the investment is made in the listed company, which are also subject to so much of variation, because so many companies which become bust over the period. So how
Listed
to
company should not be a problem because that the price is available to you, no?
Okay. So these are based on the market price. So it is not even if there's something
Yeah,
that investment goes bad, The auditors are not going to be responsible. They may not be questioned.
No, because when you made the investment, it is at market price. In a small, in an unlisted entity or a private equity, you will have to justify the valuation to make sure it is not prejudicial to the interest of the company.
There is one query in the chat box whether
Yeah.
interest provision in a loan account will be considered as loan given during the year if the interest is being added to the principal loan amount. Cumulative.
100%, because if it is added to the loan added in amount, then it is automatically a new loan which is given to that person. 100% it would be added.
It will be. Okay, sir. Thank you, sir. I don't think there is any more query from the.
Yeah. I think there is a comment on the chat box that they need a tea break. So I think that participants can always take a tea break if you want, we can break for 10 minutes if you
No,
believe.
sir. This was long back actually. This was the 4:38. No, sir. We will not go for tea break, sir.
Fine. No, I'm fine. But if someone wants a tea break, they can always go and have tea.
Let him go for tea, sir. We don't have any problem.
Okay. So I'll just go on. Now we come to this inventory which is there, and in inventory there is change in this CARO clause which is there, and the change is this, that earlier I was only talking about in material discrepancies which are there. Now I have to report on any material discrepancy which is more than 10%, and if it is more than 10%, it could be plus or minus, only then I report. Earlier I was reporting in all cases. And in now, if the discrepancy is more than 10% or less than 10%, I report, and whether such discrepancies have been taken care in the books of accounts which is there. So it is actually something in favor of the auditors, because they now need to report only if the discrepancy is plus minus 10%, not otherwise. There is one more change in inventory. This is what we discussed, the discrepancy to be evaluated on the basis of total value and not just quantity. And 10% threshold is after adjusting the excesses and shortages within each class. So I will look at 10% for each thing separately, raw material separately, finished goods separately, and so on. Okay. Now you must be wondering, in inventory, there is that other clause of this, your bank statements which you file and all. Now that we will cover it along with liabilities, because that goes with my liability or the loans taken. So that will be covered at that stage. So that really completes the asset side of the balance sheet. If anyone has anything on the asset side, you can just let me know. Of course, we can do such queries later on also, but we have really completed the asset side of the balance sheet for the Schedule 3 changes, as well as the CARO reporting on that particular aspect of the balance sheet, asset side of the balance sheet. So if I continue with this,
so there are some more liabilities, few changes also, but those are not very significant, like reporting of the security deposit under the different heads now as earlier.
So it will all get covered. If they are material, they will get covered in this presentation.
Those are not material. I don't think these are material.
Yeah, correct. So on the liability side, on share capital, earlier you are only reporting this 5% shareholding. Now, besides this 5% shareholding, you also need to now report what is the promoter shareholding. Now, promoters will be as defined in the Companies Act. It will not go as per the SEBI report, but it will be as per the Companies Act who are promoters. So give the name of the promoter, how many shares he is holding, what is the percentage of shares, and what is the change during the year. Now the change is to be computed with respect to number of shares at the beginning of the year. Now therefore in share capital, you have two information given. One is if you are holding more than 5%, that needs to be given as we always do currently. Now you also need to give promoter shareholding. It is possible that in a small private limited company, both the things are the same. So if you have got, say, husband and wife only as the promoter of the company or only shareholders of the company, they will also have more than 5% shareholding, and they will also have promoter shareholding, but you will still need to give both the information in the notes after the share capital schedule which is there. When it comes to other equity,
sir, there may be some cases where the promoter does not have any shareholding. So he's the promoter, but he does not have the shareholding.
So don't give the name. Only if the shares are held by, then you don't give the name also, no? Because only if they are holding shares, you have to give it here, no?
Okay. Okay, understood.
So if you go on, you have this other equity which is there. So in other equity, they are saying that in case there are some changes due to prior period errors, you need to restate some balance sheet of the beginning of the current reporting period. Now, this is a very restricted application, only in case there are certain errors in earlier years which are there. Otherwise, this will not apply in 99.9% of the cases, because only if there are prior period errors, then they ask you to do this change. And this was not required because you have a Ind AS 8, which anyway tells you to do something similar. So besides Ind AS 8, now you also need to disclose something like this in the Schedule 3 itself in your retained earnings. Otherwise, this was not required to be brought into the Schedule 3 as such. So prior period is,
sir,
yeah,
I'm just if there is a change in the promoter, the
yeah.
company has changed hands. In that case, we have to give the changes in the promoter's holding.
Yes, you'll have to write, no, that last year these were the promoters, this year these are the promoters. Because this information is for both years in any case.
Okay, thank you.
So as I said, in other equity, you have to look at this 108, whether there are errors. You may look at materiality also, but in case you are reporting something under this clause, you can have other tax implications, because in prior period, tax definitely comes in the picture. They may not allow you these changes as a deduction or whatever. So this is extra information which is also needed to be now given in the financial statements. Now, when you are on share capital, CARO has made lot of changes. So earlier you had this clause where only about IPO and FPO details had to be given. Now it also talks about if a company has made any preferential allotment or private placement of shares or debentures, then also you write whether the funds raised have been used for the purpose for which the funds are raised, and if not, provide details in respect of the non-compliance which is there. So earlier this was only there for IPO and follow-on offer. Now it is there for a lot of entities which is there. You will also make this preferential allotment or private placement of shares. So reporting also made applicable to preferential and private placement. In this, when you are talking about whether funds have been used for the purpose they are taken, you may not establish a one-to-one relationship, because you'll have to broadly see the cash flow statement and the current ratio. In case funds are not utilized, you need to do a reporting, and necessary consequences you will have to look into by the auditor for any provisioning, because if there are penalties or anything, then the auditor will have to look at that also. In a lot of cases, reporting will come even if the funds are temporarily invested in mutual funds. Normally, when a company does a private placement or a preferential allotment, say for a project, the project is still 1 month away, the advance is to be given after 1 month, they will temporarily place the money in a mutual fund. Now that also is to be reported, because to that extent, you are not using the funds for which you made that particular private placement or preferential allotment. When you come to borrowings, there is an amendment which is now again linked with that inventory reporting in CARO, which we will come to immediately after this. So if there are any borrowings secured against current assets, as per the amendment, if you are borrowing anything against security of current asset, you disclose whether quarterly returns are filed by the company with the banks or institutions, and if not, a summary of reconciliation and the reasons of material discrepancy. Now, some queries which come in is whether borrowings are to be assessed at beginning or at the end of the year. Now, there is also a similar reporting in CARO 2020 where the words used are during any point of time of the year. So if I take both together, if you have a borrowing at any point of time during the year, this reporting would apply. In CARO 2020, this reporting applies only if your borrowing or the limit is more than 5 crores. In Schedule 3, that limit of 5 crores is not there, but the reporting applies in all cases in the company. In CARO, I report only if my borrowings are more than 5 crores. And in here, the guidance note has said that you need to give disclosure, even there is a sanction which is there of such a borrowing. Sanction is available against current assets. It is not necessary that even the money has been drawn down to report under this particular clause. And to decide whether there is a borrowing or not, or that 5 crore limit, I will look at both fund-based and non-fund-based limits, which I will need to consider. So disclosure is to be based only on quarterly returns or statements filed with the banks, like stock statement, book debts, aging analysis, and so on. If there is any discrepancy, you give reconciliation with reasons of material discrepancy. Disclosure also to be given where borrowings are on the basis of security of assets of other group entities. Sometimes you take a loan against the security of, say, your subsidiary or some related party. That also will need to be given as a disclosure here. So I will give this information for 4 quarters for this year as well as the 4 quarters of the earlier year. Lot of companies are not giving for the earlier year because they are saying that disclosure has started this year. So I will not give it for the last year. That should be acceptable. But from next year, in any case, you will have to give this information for both the years which is there. And in practice, you must be aware that a lot of companies sometimes overstate or understate the stocks when they file the statements with the bank. Now, all that will directly get reported on this particular table. And if you also recollect, the income tax authority always wants you to give this information. Now, this information is available straight away to the tax authorities because now it is part of your financial statements itself. In CARO, as I said, they are only talking about this reporting if there is in excess of rupees 5 crore. So if it is in excess of 5 crore, that same table you can refer in the CARO report, because that table anyway would be there in the company even if it is below 5 crores. So in CARO report, you can only refer to that table. Otherwise, the reporting remains the same. And it is surprising why CARO there is a 5 crore limit, whereas in Schedule 3, there is no limit of 5 crores or anything which is covered as such. So in 5 crore, again, I look at sanction limit. I have to look at balance outstanding at any point of time during the year, limits of all banks and institutions. I will consider it should cover both fund-based and non-fund-based limits. Now, comparison with quarterly returns is based on what is submitted to the bank. And a lot of people say that I have sometimes submitted a revised report to the bank. In that case, I will use the revised report and not the initial report which is submitted to the bank for this inventory and other book debts which are there. Okay. So any issues or any comments or queries
Yes,
on
sir.
this inventory?
In case the company does not, the management does not give the prior period, previous year's figures, then should we report in our audit CARO report that management has not given the previous year's detail?
No, it is not reported because that's a debate which is there, and few listed companies who have not given, the auditors have not reported there. So I think this year you can get away with not giving previous year's figures by saying that this was the first year of requirement in this Schedule 3 which is there.
Okay. And what is the material? Whether you are writing the material discrepancy, but I think the CARO reporting does not have any word like a material. No, in no way.
What we do in practice is we take 10% as a materiality. So if the difference is more than 10%, then we consider it material. Otherwise, we consider it immaterial.
Immaterial. So in the CARO also, we should say there is no material discrepancy. We should write it.
Correct.
Otherwise,
but you'll have to write somewhere internally or take a representation that we are considering this as a 10% materiality level.
Okay.
Sir, where the amount declared in the bank to the bank has changed based on subsequent, computation of inventory valuation. Should we report? I mean, that could be a difference between earlier disclosure and the latest one. What should be the role of?
So you will have to disclose, no? It will have to be disclosed here, no? Unless you are filing a revised statement with the bank. If you are filing a revised statement with the bank, it's all right. If you are not filing a revised statement, then it will come in this particular table.
Okay. So if you are filing a revised statement and if the bank accepts, then we can go with the revised statement.
Correct. Then you may not bring it in this table. Otherwise, you will have to include in this table.
Okay.
But you should remember that if you are having differences in this table, you will have to also face a lot of issues with the income tax department, because this is information which they readily have now. Earlier, they were calling for it. Now they readily have this information. on a quarter-on-quarter basis.
Because generally when you do a stock valuation from ERP system and subsequently when they are looking at AS2, there could be some variations, no? I'm talking of those kind of situations.
No, that is possible, but then you'll have to justify, that to the tax authorities if they ask for. And here, even here, if there is a discrepancy, you may have to write the reason, that this reason is because of the valuation which is done as per Ind AS 2. You'll have to give that as a reason also then. The reason may be correct also. This disclosure doesn't tell you that disclose only if there is a positive thing or something. You have to give the reason why the discrepancy arose. That's all. It may be right, it may be wrong, but you have to give the reason here.
Okay. Thank you.
Okay, so I just go on further to borrowings. Discrepancy in utilization of borrowings. In existing requirement, there was something which is there on the top. In the new requirement, in addition to the above, if we have not used the borrowings for the specific purpose for which it is taken, the company shall disclose of where they have been used as such. So this is an extra reporting which has come in. So if I take a loan and I don't use the loan, say for my project, then I have to write in the financial statement where this has been used in that sense. If you come to CARO, clause number 9, there are a lot of disclosures on these loans which are there, and there are again 6 sub-clauses over here. And you can see the difference from the earlier reporting and the new reporting which is there. Now, in the new reporting, which is on the right-hand side, whether the company has defaulted in repayment of loans or other borrowings or in the payment of interest to any lender, if yes, what is the period and the amount of default as per the following format. So nature of borrowing, name of lender, amount not paid on due date, whether principal or interest, number of days delay or unpaid, and remarks. So if you have defaulted in anything, you'll have to write it here. Earlier, it was just to maybe banks, institutions or something. Now it is in respect of all borrowings, whether you are defaulting or something. In CARO, it gets reported. So all borrowings are covered, secure or unsecured. Public deposits not covered only because it is separately covered in another clause. Default means non-repayment of dues to lenders on the last date specified in the loan documents or the debenture trust deed. Reporting for debt securities and defaults to be provided lender-wise. A clause will also cover rescheduled, restructured loans, disputed loans, and borrowings on demand. And for reporting under this clause, for the delay, you have to consider the delay up to the date of the audit report, not just the balance sheet date, because that is what the guidance note says, that you consider delay as the date up to your audit report, and any amount that remains unpaid is to be considered. For loans repayable on demand, you give an appropriate disclosure that the loans are repayable on demand and hence there is no delay which is considered in that sense. You have another clause on diversion of loans, whether term loans were applied for the purpose for which they were taken. If not, and the amount of loans so diverted and the purpose for which may be reported. We saw that in Schedule 3 also a similar reporting is there, a disclosure is there, and the auditor also has to report something like this in his CARO report. So again, this is for term loans. If I obtain the term loan from entities other than banks, they also need to be considered. A diversion would indicate what is defined as a diversion by the Reserve Bank of India. And you again need not establish a one-to-one relationship. I may just look at a cash flow statement to decide whether it is used for the purpose it is obtained and so on. So establishing one-to-one not really important. Auditor to report if the company has financed long-term assets out of short-term funds. Comparison would be required for long-term sources and long-term application of funds. Review would be required of balance sheet, cash flow statement, and current ratio. And this is the suggested reporting format. Nature of funds raised, name of lender, amount diverted, purpose for which loan sanctioned, purpose for which utilized, and remarks. Now, all this information is very ready information to the bankers, because if you write this in your CARO report, the banker will immediately know all these details and they may start taking action against you. But in any case, the auditor has to report this. These columns are also given in the guidance note itself for reporting by the auditor. Then short-term funds used for long-term purposes, again, a new clause which has come in. It was there earlier before CARO 2016. It has again come in this new CARO 2020. Again, the same logic, whether you are borrowing something for short-term purpose, but using it for long-term. So if it is a cash credit and you are using it for making investments, or you are using it for your project, then reporting will come under this particular clause. Clause 39E, whether you have taken any funds from any entity on account of or to meet obligation of subsidiary, associate or joint venture, and if so, details of such transactions and the amount in each case. Now, this is again a new clause which says that if you have borrowed something to meet obligation of your subsidiary, associate or joint venture. So my joint venture needs money, my subsidiary needs money, I have borrowed money and I give it to my subsidiary, then I will report under this particular clause which is there. It's a new clause for reporting. Similarly, if I have raised any loan on the security of assets of my subsidiary or GV or associate, I need to give details here. So I don't have asset to pledge, but my subsidiary has got assets to pledge. I pledge those assets and take loan in my company. That also is a new reporting which is come under this CARO 2020 clause which is there. So in CARO, you have two very big clauses. One is clause 3.3 and the other is clause 3.9. Clause 3.3 is for loans given and clause 3.9 is for borrowings. Now, each one of these clauses has 6 sub-clauses. So total 12 clauses to report on loans given and borrowings which are done. And these 12 clauses are the most important clauses to report under CARO. So when you are making an audit report, at least concentrate on these 12 clauses, because this will be very critical even from the banker's perspective, from the regulator's perspective. And therefore, if there is any wrong reporting there, the auditor also can be held responsible if some wrong reporting goes in these 12 clauses of CARO 2020, which are there as such. Go on further to lease liabilities. Here, just a classification change. Earlier, it was all into one classification. Now it can be classified separately under non-current and current liabilities. On trade payables, this is the existing requirement, just a simple requirement, but now trade payables are to be disclosed like this. Less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 4 years. Again, unbilled dues to be disclosed separately. Now, just as we disclose trade receivables, we also disclose these trade payables under this particular categories which are there. And again, lot of information available to say the income tax officers, because if there is a trade payable of more than 3 years, the officer will say that why you are not paying that, I will add it back to my income. Now that is also as the audit process, you will need to consider whether you need to add it back to your income and so on. But this is again lot of information which the company needs to gather for both years, current year as well as previous year. And the auditor will have to validate this particular information also, which is there as such. Okay.
Sir, there's one query here.
Yeah.
Regarding this, earlier there was only micro and small enterprises, but now it is MSME, all micro, small and medium enterprises.
Correct.
And number 3, again, so far as disputed dues, MSME and disputed dues, others is concerned. Here again, we have to rely on the management representation only, or we have to go
no,
to
you can verify, no, you can verify, no.
How do we know if they are the disputed one, even if these are the old ones, unless
so
there is some legal document?
You have to look at correspondence, no?
Correspondence, yeah.
Yeah, you have to look at correspondence. But see, as an auditor, you cannot always say, I will look at the management representation. You may look at correspondence also.
Yeah, that we can always see in case of the old dues, if there is any, or we can seek the report from the client's advocate, lawyer also.
Right, you'll have to look at your ERP system, everything you have to look at whether the information is reliable, not reliable. Because again, as you rightly said in the beginning, the auditor has to take that responsibility.
We can also write directly to the this creditors also whether why this amount has not been paid, if there is any dispute. We can seek that help.
Yes, so you'll have to ask for all details of the dispute which is there, no?
No, we can write directly to the creditors also as an auditor to
Yes,
give the
yes, that
information.
confirmation also will be there, no? You can also obtain
Yeah.
confirmation, no?
You can say control that.
Ah,
Because I think in case of the old dues, this responsibility will be there on the auditor. And
correct,
they should have
correct. That is right. That is right.
uh,
That is right.
again, in case of the disputed dues, the income tax department we may have some problem with the income tax department also.
Yeah, that is possible because a lot of information is now available straight away with the income tax department. So that is also needs to be done properly now.
Sir, one more query I will tell you, it is a bit silly query. Say on 31st March, there is some creditor and that amount is due for payment within 30 days, say on 30th April of the next year. So where it will be clubbed?
Less than 6 months, no?
But then on 31st of March, it is not due for payment.
So you add one more column. There is one more column there, not due or something.
Not due.
You can add one more column, no?
Not due for payment.
Not due for payment.
Okay, thank you. Because in case of many creditors, there is no stipulation with regard to payment. So in this case, date of transaction will be the due date.
Correct, correct. Then it will all be less than 6 months or wherever it falls in.
But again, see, it's a very huge task because we have to go for each and every creditors and what is the stipulation with regard to payment.
But if you want to audit and sign off balance sheet, you have to do all this, no? You cannot say that I will not do all this.
I can understand. I'm not saying that. But then it's a huge task so far this aging is concerned.
Correct, correct.
Debtors and creditors has very, very huge task.
Correct, correct. But that is what the auditor responsibilities are going up and up, no?
Yes.
Okay, on short-term borrowings, this is the existing requirement. Now you will have to show your current maturities on the short-term borrowings separately, namely current maturities of long-term borrowings. Earlier, it was all grouped under the same head. Now they are trying to tell you to show it separately. Then on this borrowings, on this deposits and deemed deposits, you have got this clause which has come. In case the company earlier, it said only accepted deposits. Now it also talks about deemed to be deposits. Now, apparently it looks very simple, but when it talks about deemed deposits, and this is what is deemed deposits under the rules, there are these 7 items which are considered as deemed deposits. And if you fall under anything of this, then you are also violating section 73. Earlier, you are not reporting this directly because earlier you were reporting on only deposits. Now you are also reporting on what is deemed to be a deposit. So if you have got, say, for instance, take that immovable property thing. If you have got an immovable property and you have received an advance and that is not adjusted against that property, then it's a deemed deposit. If you have got an advance from a customer unsettled for more than 365 days, then it's a deemed deposit. Share application money, you already know that if I don't allot shares within 60 days, it's a deemed deposit which is there. So in case you fall in any of these 7 items, then you are going to say that there is a deemed deposit and therefore section 73 will get violated, and section 73 is violation is a very stringent penalties for violation of section 73. So you need to be careful about such things, or the companies need to be careful about such things which are there. Earlier auditor was not reporting, but now auditor has to report directly on such violations. Okay, so that's that last thing under the liability side of the balance sheet, where we discussed both the changes which were there in Schedule 3 also on the liability side, and also what were the corresponding changes in the CARO reporting by the auditors which are there. So any queries so far before we move on really to that profit and loss? I can see something on the chat box. So I'll just go backwards. If bill date and transaction date is different, then the due date is calculated from which date? It will be the bill date. There is nothing like a transaction date. Then if loan is taken taken is used temporarily for some other purpose, reporting is still applicable. It doesn't talk of temporary, permanent, anything. Loan not used as the investment was not ready to invest. If you want, you give the reason, but the reporting will still be there. In case new company, how percentage of change to be shown? If it's a new company, then you don't show the percentage change, because you will have zero figures in the last year. Okay. Whether interest provision in the loan account will be considered and added to that, we already answered. So I think these were the queries which I could see on the chat box. So if there is nothing else on this balance sheets, we did the asset side first, we did the liability side thereafter, then we now go to what is now the profit and loss side.
The retention money which is kept for in case of capital goods, the transactions, there could be some retention money which the companies keep, the clients keep. Correct. For a year or so. In that,
so you are talking from the receivable side or payable side?
From the payable, it will be, of course, a current asset as far as the seller is concerned. But for companies who buy a capital goods, it will be a retention money kept for purpose of ensuring that the machine or something is,
So what we normally therefore do is, it will come under more than 3 years, but you can write a footnote over there, includes retention money which are not due, something like that.
Okay.
You can add that note.
Okay.
Both ways, in the receivable also and in the payable also. So you come to this profit and loss. There are only very few changes here. One is on this revenue from operations, and this change is only for a Section 8 company. But if you are receiving any grants or donations by Section 8 companies, then you need to disclose it separately for a non-profit organization. Then the only other change is in this disclosure relating to CSR activities on the expense side. Beside these two, there are no other changes in the statement of profit and loss. So this is one change, and this is only for Section 8 companies. So we don't need to discuss this because so far they were always grouped in revenue from operations. Now they are going to show separately grants or donations received as part of their revenue or below revenue from operations. Now, however, there are some other extra items which are required in the profit and loss, which are given in Schedule 3. Now, one of this is on this undisclosed income, which is there. And they are all new disclosures. So as per the amendment, company shall give details of any transaction not recorded in the books of account that has been surrendered or disclosed as income during the year in the tax assessments, like search, survey, and so on, and whether the previously unrecorded income and related assets have been properly recorded in the books of account. This table is also given: serial number, assessment year, section of the act, amount disclosed, transaction description along with value, assessment status, whether recorded in books of accounts, and the financial year in which transaction is recorded. And there is a corresponding clause in CARO also, 3.8, whether any transaction not recorded has been surrendered as or disclosed as income in the tax assessment under the Income Tax Act, and if so, whether previously unrecorded income has been properly recorded in the books of account which is there. Now, if you look at the guidance note, which is given both of Schedule 3 as well as the CARO guidance note, it talks about only Section 158B, which talks about undisclosed income. So it talks about undisclosed income only arising out of a search or a seizure which is there. It does not talk of undisclosed income which is added in my regular tax assessment. So in my regular tax assessment, there is an expenditure not allowed on which I pay tax, or there is an asset which they say that I am adding this as an undisclosed asset or something that may not get reported because it only talks about this 158B, which really talks about this search or seizure which is there. Now, whenever it comes to a search and seizure, there is always a lot of gray area, because in a search or seizure, even if there is unrecorded income, there would be a lot of litigation on that. There could be a statement which has been withdrawn later on. There would be a surrender withdrawn later on, and so on. But finally, in case there is a disclosure which is done by the company on account of, say, undisclosed inventory, undisclosed fixed assets, or undisclosed expenditure which was not recorded in the books, then reporting under this clause, under this table, becomes very important. Now, what both the guidance notes say is that in case there is some reporting under this particular clause, for an auditor, it becomes very difficult to decide whether the company is properly maintaining its books of accounts, because clearly it is hiding something from the auditors because it has declared something in the search or seizure also, and therefore reporting under this clause has now come in the schedule 3 as well as in the CARO report which is there. So the guidance note clearly says that in case you are having something like this, find out whether the internal financial controls are operating effectively, whether it amounts to a fraud committed by the company on the financial statements, and so on and so forth. So this is a very difficult disclosure to give, and in case you give such a disclosure, the auditor's responsibility also will increase multifold, because now it is saying that I am not able to rely 100% on the company because it is hiding information, because a lot of assets or something has come out in the search, which it has ultimately disclosed before the tax authorities who are there. The next is on this CSR. As we said, on CSR, there is a change which came in. So this is the existing requirement which was there. In the new requirement, you have to give this 8 things which are there. So if a company is covered under 135 of the Companies Act, which is CSR, the following shall be disclosed: amount required to be spent by the company during the year, amount of expenditure incurred, shortfall at the end of the year, total of previous year shortfall, reason for shortfall, nature of CSR, details of RPT, whether it is given to a related party or someone, and whether a provision is made in the with respect to a liability incurred by entering into a contractual obligation, what is the movement in the provision. Now, the above details are needed to be consistent with the details submitted and approved at the CSR committee of the company. Because the companies will have a CSR committee, they will have minutes of the CSR committee, they will include all these things in the director's report. All that has to be consistent, because now these 8 things which you need to give has to be given clearly for this year as well as the earlier corresponding previous year also. In CARO also, there is a clause, which is the last clause, which is there on CSR. And there it says that if it is on respect of other than ongoing projects, whether the company has transferred the unspent amount to a fund which is specified in Schedule 7 within 6 months, and also if there is any other amount which remains unspent, whether it has been transferred to a special account. Now, if you recollect CSR, if you give all the information here and there is a shortfall which is there, then if it is for an ongoing project, as per the new provisions, you have to transfer it to a separate fund within 6 months. But if it is for an ongoing project, I have to only transfer to a special account. Now, as auditors, we are supposed to report that under this clause 320 of CARO, whether it is transferred to the fund or whether it is transferred to a special account which is there. So now CSR is not only the company's responsibility. Earlier, companies used to say that CSR is not mandatory. We will not do it now till the government comes with some circulars or some action or something. Now, not only it has become mandatory, all the information needs to be given under this 8 items. And the auditor is also now going to report whether the company has complied with properly all these transfers to a fund or transfer to a special account within that 6 month or whatever period is given in that section which is there. So it's a new clause. And I need to correlate all this with everything. And I also need to comply with this AS 29 if it's a non-Ind AS company, or Ind AS 37 if it's a Ind AS company. So CSR really becomes very important now. And this, as you know, also covers private limited companies and all companies who are falling under that CSR guidelines which are there. Okay. So any queries on this CSR or the earlier one on the search seizure thing?
So in the search and seizure, we have stated one line: if the amount is disclosed due to coercion by the tax authorities. उसको थोड़ा सा clarify थोड़ा सा कर देते ना.
No, I could not understand your query.
एक आपने जो कहा था जो इनकम डिस्क्लोजर के अंदर में if there is any amount disclosed by your coercion by the income tax department which is not admitted but forcefully they have to declare in the
So
income
that will not get covered here. No, that will not get covered here because you are not disclosing that. It is under force and you are disputing that addition.
Okay.
One query is that hopefully surveys are not covered. Unfortunately, surveys are also covered if you are going to disclose something in a survey and not dispute that. And if something is reported under clause unreported income, shall we also include the same under fraud? The answer could be yes, because it clearly amounts to a fraud, and we will cover this when you go to that clause on fraud reporting under CARO.
Sir, in case of Sir, in case of this surrendered income, undisclosed income, what we were talking, so whether this disclosure, suppose search had been taken 3-4 years back, so whether we have to report for the any such taken during the financial year under audit?
No, you will have to report of any undisclosed income which is disclosed during the year. I don't have to worry about earlier years. But if the search is earlier and the disclosure in this year, I will still need to report on that.
So will this disclosure lead to qualification also?
It can. As I said, if there is a disclosure given on account of a search, then you are not sure what else the company is hiding from you. Then you may need to give a qualification also, but that is depending on the facts of each case. But it can, one query was, is it a reporting under fraud also? Yes, that is also possible. But it depends on how much trust you have in the company, and maybe you will do a little more detailed audit in such a case of that company's books.
But sir, some disclosure was made and that has not yet been accounted for, and now they want to account for it. So in that case,
but if it is accounted during the year, you will have to report under CARO about it.
So then it will raise fingers on the auditors, even the then auditor.
Yeah, that is right. No, but why are we worried about the past? We should only worry about what I am certifying now. No.
Okay.
Obviously, it will raise fingers on whoever has certified in the past, but you cannot, if you don't certify this, someone else will certify this.
Okay.
The next disclosure in the profit and loss is about this cryptocurrency or virtual currency. Now, every day you read a lot of things about this cryptocurrency, virtual currency and taxation, TDS, and a lot of new things have come in. You must have also read that most people make losses in this cryptocurrencies and all, but the Schedule 3 says that in case the company has dealt with any cryptocurrency, traded or invested in cryptocurrency, you give this information. Profit or loss on transactions involving them, what is the amount of currency held at the reporting date, and deposit or advance from any person for the purpose of trading or investing in cryptocurrency. Now, the guidance note gives a lot of disclosure details about what is a virtual currency, what is cryptocurrency, what are this central bank digital currency, and so on. But ultimately, the disclosure is only of those three things which are there. And as you are aware by now, there are a lot of tax implications if you deal in this cryptocurrency or virtual currency. Then there are other disclosures on, say, Benami properties. So if there is any proceeding initiated against the company for holding any Benami property, you have to give this information. Now, the guidance note has given 4 pages of what is Benami property. And in case you have something like a Benami property, you have to give all these details which are there. Details of the property, the amount, who are the beneficiaries. If it is on the books, then reference to that item in the balance sheet. If it is outside the books, state why it is not in the books, whether any proceedings are against the company, then give details thereof, what is the nature of proceeding status and the company's view on those Benami properties. Again, when you have such a disclosure, the auditor is going to start questioning whether there is a fraud, whether how do I sign off, whether I need a qualification. All that questions will automatically come up if this Benami property disclosure is given in the balance sheet. Now, there is a corresponding reporting under CARO also for Benami properties. So whether any proceedings are initiated against Benami, against the company for holding Benami property, you need to give a specific disclosure there also. Okay, then willful
Sir,
defaulters.
yes, the property includes only the land and building, immovable property or any other investments also.
See, Benami Property Act, covers everything which could be even investments, because they may say that you are holding this from undisclosed income, so it's a Benami property. So it can include even stocks, even inventory. It can hold shares. Anything can be covered in Benami property.
Again, beyond doubt, sir, once the company reports and the auditor has to report, this has to lead to the qualification.
So you'll have to see the circumstances of that case, what it is, how genuine it is, how bad it is or something. Sometimes the auditor may even decide, I don't want to continue the audit. I would like to resign from that audit. You may also decide sometime that way also. No?
Because when you say you have to judge, judgment becomes very difficult for the auditor to judge whether this is correct or not.
Yeah, but then all this disclosure is actually helping the auditor. No, earlier he was not knowing only all these things and he was blindly signing everything. Now at least he knows a lot more things. No.
Yes.
So auditors will become cautious, and if the company knows that the auditors are becoming cautious, they will also become more careful in future. No.
Yeah.
So there is this new disclosure on willful defaulters. So if a company is declared a willful defaulter by any bank or institution, you give details here. Here it is only the Reserve Bank of India can call you a willful defaulter. A willful defaulter does not mean that you are a loss-making company. Willful defaulter means that you have the money to pay the bank loan, but you are deliberately not paying the loan, but using the money somewhere else. Then the Reserve Bank will call you a willful defaulter, and that list is available with the bank or the Reserve Bank. And in such cases, you have to write that in your disclosures below the profit and loss. Even in CARO, you'll have to report under this clause 39B whether company is declared a willful defaulter by any bank or institution. And this is at the date of the balance sheet. Then relationship with struck off companies. Now again, Schedule 3 says that if in case the company has any transactions with companies which are struck off under Section 248 or Section 560, the company shall disclose following details. Now, when it comes to Calcutta, I think you understand this much better than other parts of the country, because what we read is that in Calcutta, most of the companies which were struck off were based in Calcutta or east of India as such. So in case you have got any transaction with a company which is a struck off company, then you have to give the details. Now that could be investment in securities, receivables, payables, shares held, or any other outstanding balance. And these details are available through a search which can be carried out. But this information would be very useful, because if you say that there is a receivable from a struck off company, you are never going to get that money because that company is not able to operate at all. Or if there is money payable to them, again, it is very useful information, because you may not like to pay money to a struck off company in that sense. And you also need to give relationship in case the relationship is your, say, own related party or something, then all the more reason that this could become a difficult disclosure to make. But this is a new disclosure which has come under the Schedule 3. Then layers of companies. If a company has not complied with the number of layers prescribed under 287, the name and the CIN of those companies beyond the specified layers and the relationship extent of holding of the company in such downstream companies shall be disclosed. Now, this is only not applicable to banking company, NBFC, insurance, and a government company. Otherwise, to all companies, this applies. Now, if you see the rules which are given, in India, you can have only 2 layers of companies. You cannot have more than 2 layers of companies. Now, in case a company has more than 2 layers of companies, they will have to disclose this, and the auditors will also have to validate whether this disclosure is proper or not proper. And therefore, this again becomes a very important disclosure which is there. Then this ratios. There are this 11 ratios which need to be, or 9, these are 11 ratios which need to be given. And these ratios are to be given for both years, last year as well as this year. So the company shall explain the items included in the numerator and denominator for computing the above ratios. Further explanation shall be provided for any change in the ratio by more than 25% as compared to the preceding year. Now, a lot of these ratios are given to the bankers. Sometimes the income tax authorities also ask for these ratios, and these ratios are also used for audit analytical procedures. Now, all that is automatically now going to come in your balance sheet itself, in the financial statement itself. And the disclosure is not only the final ratio, but how are you calculating the ratio? What is the numerator? What is the denominator? And in case there is a change of more than 25% from the earlier year, you have to give a reason as to why there is a change from the last year to this year. The 25% could be both plus or minus, which is there. Sometimes these ratios can become difficult because if you have got three different businesses, say you have got a trading division and a manufacturing division, the ratio is a combined ratio for the company. So a combined ratio for the company, which is manufacturing and trading, that may not have any meaning, but still you will have to give the ratios which are there in all the cases which are there. And some of these ratios from a bank's perspective can become difficult. Say your current ratio, your inventory turnover, trade receivables turnover, and so on. In case the banker says the ratios had to be minimum so much and these ratios are different from that, earlier you could submit explanation to the banker about the ratios. Now you may not be able to do that because this comes straight on the balance sheet itself. You also know that a lot of these ratios are given in the tax audit report. Now the tax audit report would be made much later on, but you will have to ensure that the ratios which are given in the tax audit report also match with the ratios which are given in this particular balance sheet in Schedule 3 disclosure also. And if you look at the balance sheets which are available as of now of say Infosys, TCS, you have got for Trent Limited and so on, all these ratios they are giving in detail. What is the numerator, what is the denominator, and both the numerator and denominator has to line up with some line item in your financial statement. It cannot be an abstract figure. You will have to give as to where that figure is coming from the financial statements also. So this is the 1 minute. Let me complete. Okay. This is that same thing. So this is the table which they are saying. What is the ratio? What is the numerator, denominator, current period, previous period, percentage variance, and reason for variance. Items taken should have a reference to a respective line item. Items need to be consistent for periods presented and with industry over time. In case of any change, should be for all periods presented. And the ratio should be consistent within the director's report, management discussion report, and so on. So this is a very difficult disclosure, and but a very important disclosure which is coming in for all sorts of companies, small, big, everyone. Yes, please. What is your query?
Sir, I got your answer, sir, by this table.
Achha.
I got your answer.
Okay. Fine. Scheme of arrangement. This is one more disclosure which is coming in the financial statements now as per Schedule 3. So if you have a scheme of arrangement which is approved by the competent authority in terms of sections 230 to 237, the company shall disclose that the effect of such a scheme have been accounted for in accordance with the scheme and in accordance with accounting standards. So if you have got a merger, demerger, or any amalgamation as per this sections 230 to 237, this clause will become applicable for reporting. And even small private limited companies, if they have got such a scheme approved, then you will have to give this disclosure. Then registration or satisfaction of charge with the registrar of companies. If you have got any borrowings, whether any charges or satisfaction yet to be registered with ROC beyond statutory period, you have to give details and reasons for the same. Now, this is something which the secretary or the secretarial department will actually be aware of. But this information also needs to be given. So if you have taken a loan, whether a charge for the asset is registered with the ROC, if you have repaid the loan, whether satisfaction of charge is also registered with the ROC. If it is not done, then give all details of delay, and there is a strict penalty payable if there are delays in this filing the satisfaction or registration of charge. So the secretarial department of any company will have to be up to date with all these details because they will need to be disclosed now in the financial statements. So that completes really that schedule 3, but there are some other CARO clauses also which we need to discuss. These are the new clauses which have come in. Now, all the remaining clauses of CARO are covered here. So on this clause 3.6, there is no change on the cost records which is there. On the clause of statutory liabilities, earlier it was only covering sales tax. Now sales tax, since it is replaced with GST, it covers GST now. Sales tax also gets covered because some states there is still sales tax, especially where there is excise duty. So, but GST also gets covered here. And it talks about undisputed amounts which are not deposited and they will become reportable. And some illustrations which we believe get sometimes reported or missed out are, say, advance tax installments, provident fund dues, adjustments for GST. Now, if these are undisputed, they will become reportable under this particular clause of CARO. If they are disputed, if they go into the next clause. But if they are undisputed, could be advance tax installments. So if, say, for instance, the company does not pay advance tax at all, and it has got profits through the year, then it's undisputed statutory liability which is not paid, and I will have to report in CARO that the company has not paid any advance tax, though it is otherwise liable to pay advance tax. Similarly, for provident fund dues, for adjustments for GST and so on. Then on statutory liabilities, again, this is the change for disputed amounts. Again, they are referring it to all amounts which are in the earlier clause, and they are not just restricting to only income tax or sales tax or anything. They are referring to everything which was referred in this earlier clause of 3.7a. Then in this particular clause, there are some debates which always keep on going, that whether a show cause notice represents a demand, and the answer is typically a show cause does not represent a demand unless it's a recurring demand. You have to reconcile this with the statement of contingent liabilities as per AS 29 or as per Ind AS 27, and the reporting format is given by the guidance note: name of the statute, nature of dues, what is the amount, period to which it relates, forum where the dispute is pending, and so on. Then on fraud reporting, which was earlier referred to, that when this search or seizure happens, what happens about the fraud? Now, if you see this, they are now removing this by its officers or employees, and now it only says whether any fraud by the company or any fraud on the company has been noticed. And if so, the nature and amount involved is to be indicated. Now, fraud by the company can cover cases of search and seizure where there is undisclosed income. So as rightly discussed earlier, if there is a undisclosed income or if there is some benami property or something, can it be called a fraud by the company? Now, again, depending on the circumstances of the case, what is the judgment of the auditor in that particular case? If it is, if the auditor believes that the company has been hiding information, it can amount to a fraud by the company and can get reported under this clause. And the CARO is also adding one more subclause, which is whether any report under subclause 12 has been filed by the auditors in form ADT 4 as prescribed under Rule 13. Now, this talks about any fraud which is more than 1 crore, for which I need to file ADT 4 with the Ministry of Corporate Affairs. So if that form is filed under 143.12, then it will get reported under this particular subclause. And this is the discussion in the guidance note on fraud. So I have to look at SA 240, auditor's responsibility relating to fraud, SA 450, evaluation of misstatements identified during an audit. And if you see that last bullet, consider other clauses of fraud in CARO 2020 that can have an implication on this clause. One is this discrepancy reported in the returns and the statements submitted to banks. So if I submit something to the bank which is much higher than the stock which I am having, that can indicate a fraud. There could be the unrecorded transaction to tax authorities which can result in a fraud reporting. Whistleblower complaints is in the next slide, but that also can result in a fraud being reported in this particular clause. So as we said, there is this whistleblower reporting also, whether the auditor has considered whistleblower complaints, if any, received during the year. Now, Companies Act has a section on whistleblower mechanism, section 177(9), and listed companies also have to have a whistleblower mechanism, which is under SEBI LODR. So whether the company has a whistleblower mechanism, and if so, whether any complaints were received by the company, and whether the company has taken any effective action against the same. If earlier complaints were there, it does not need to be considered because the clause only wants you to report on any whistleblower complaints received during the year and not in any earlier year as such. There is this clause on Nidhi companies. This is not really what we discussed because Nidhi companies are typically only in the south of India. And in case you are auditing a Nidhi company, then this reporting also comes in this clause of CARO. Related party transactions, the same clause is there. Last CARO 2016 and the new CARO 2020, the same clause is there for related party transactions. On internal audit system, there was no reporting earlier, though in CARO 2003 there was reporting, CARO 2016 no reporting, but now two things to be reported under internal audit. Whether the company has an internal audit system commensurate with the size and nature of its business, and whether the reports of the internal auditors for the period under audit were considered by the statutory auditor. So two things, whether the internal audit system is commensurate with the size of the company. Now there is this section 138 of the Companies Act, which tells you whether internal audit is required or not. And some factors which are considered to design internal control system or internal audit is size of the internal audit department, qualifications, reporting responsibility, what is the involvement of the internal auditors, what is the scope and extent of coverage, and assessment and remedial action. The guidance note requires the management to consider all internal audit observations that can have a financial impact on the figures of the company. Now, typically, we say that internal audit function should cover these 5 things. So it should cover evaluation of internal controls of significant processes, which is also what we refer as ICFR or ICOFR. It should also have examination of financial and operational information, review of operating activities, review of compliance of laws and regulations, and evaluation of risk and management and government practices. If you have all these 5 things, one can say that you have a proper internal audit system commensurate with the size and nature of operations. Otherwise, you may not be able to report positively whether the internal audit system is commensurate or not. Even if the internal audit system is commensurate, you will have to report whether as statutory auditor, you are considering all the internal audit reports for the period under audit which was there. So if the internal audit report is received very late, then the statutory auditor can say that, yes, though there was the internal audit, we have not considered the reports for our statutory audit or something. Then you have this clause on non-cash transaction. This is the same clause which was there last time also. So we don't really discuss this. Companies registered with Reserve Bank of India, the earlier clause has been made much more detailed. So whether company is required to be registered with RBI, that's the earlier clause. You also need to comment whether company has conducted any non-banking financial or housing finance activities without a valid certificate of registration. Whether the company is a core investment company as defined by RBI, and if so, whether it continues to fulfill the criteria of CIC. Whether the group has more than one CIC as part of the group, and if yes, indicate the number of CICs which are part of the group. So a lot of disclosures from RBI perspective, and so far we are only looking at the 50-50 test as we call it. If my more than 50% of the asset are financial, and if more than 50% income is financial, then I'm eligible to or liable to take a registration under RBI as a non-banking financial institution. And if not, I will have to report under this particular clause which is there. Reporting under this clause can also have other implications, because you also may need to report directly to RBI that the bank or the company has conducted RBI or borrowing activities without obtaining a registration or something. So this is a new clause, as we said. And you also have to comment whether you are having whether it's a core investment company which is there. One more clause is whether a company has incurred cash losses in the financial year and in the immediately preceding financial year, and if so, what is the amount of such cash losses? So if this is more from a cash flow angle, you can find out that whether a company has losses or something, and if so, whether what are the amount of cash losses. Again, you'll have to decide. Cash losses means you have to make adjustments for non-cash transactions like depreciation, amortization, and so on. And also for that fair value changes which are in Ind AS. Also, your qualification in audit report adjustments may need to be carried out to determine whether a company has incurred a cash loss. And there are a lot of the discussion on this given in the guidance note as to how do you finally compute a cash loss for a particular case. Then a new clause is on this resignation of statutory auditors. So during the year, have any statutory auditors resigned? And if so, whether the objections given by the resignation auditors have been considered by the current auditor who is there. This does not apply in case of rotation of auditor and a new auditor appointed, but in case there has been a resignation and then a new person appointed, then this clause becomes reportable. Even in the case of a joint auditor, if the joint auditor is resigned and the other auditor continues, this clause will still be applicable in terms of the guidance note. Then this is a new clause whether the company is capable of meeting liabilities. And this is a clause which we are talking about the future of the company, whether in the next 1 year, the company has capability to meet its liabilities. So on the basis of financial ratios, aging and expected date of realization of assets and payment of financial liabilities, other information accompanying the financial statements, the auditor's knowledge of the board of directors and management plans, whether the auditor is of the opinion that no material uncertainty exists as on the date of the audit report, that the company is capable of meeting its liabilities existing on the balance sheet date as and when they fall due within a period of 1 year from the balance sheet date. So it requires reporting on the company's ability to meet its liabilities falling due within 1 year. Now I'm really talking about financial assets and financial liabilities. And this also has a connection with the going concern of the company. In case of profitable companies, this may not be difficult to report, but in case of loss-making companies, this could be difficult to report, and you will have to discuss with the management, consider all your ratios like current ratio, cash ratio, the inventory ratio, and so on. You may have to look at the projections of the company, the annual operating plans of the company, whether they are able to meet their liabilities going forward in the next 1 year and report on this particular thing. Then the last clause in CARO is on this consolidated financial statements, and this is that clause. This is just the circular on consolidation where the circular says that in consolidated financial statements, only things which are relevant for consolidation are to be consolidated. Everything need not be included in the notes to consolidated financial statements. And in CARO, for the first time, in CARO also I have to report on consolidated financial statements. So whether there are any qualifications or adverse remarks by the respective auditors in the CARO reports of the companies included in consolidated statements indicate the details of those companies and the para numbers of the CARO report containing these. So if I have got a subsidiary, if I have got an associate, if I have got a joint venture which I am consolidating, I look at the CARO reports of all those entities, and if those CARO reports have any adverse remarks or qualifications, I will also need to bring it in my consolidated CARO report which is there. So this is sometimes going to make a consolidated report very lengthy, because take a case of a company like Reliance, it may have got 100 subsidiaries. All those subsidiaries reports I have to keep and consolidate together in that sense. Okay. So for those entities to whom CARO applies as separate annexures, every qualification should be included. If the report is not yet included, you'll have to say that the report of that component has not yet come, and so on. To interim financial statements, this new schedule 3 also applies. So whenever I prepare interim financial statement, also this schedule 3 changes also apply. Then there are two other changes in the audit reporting, which is this Rule 11 of Companies Act. You have got this Rule 11 Clause E, which says that whether the management has represented that to the best of its knowledge and belief other than as disclosed in the notes to accounts, no funds have been advanced or loaned for circular trading, or no funds have been received by the company for that circular getting of the money by myself. So basically for evergreening, I am not advancing funds, nor I am receiving any funds for this evergreening, as it is called. And before about 2 weeks, the institute has come out with the implementation guide for this particular rule 11 of the companies audit rules which are there. And it's a very detailed implementation guide, about 80 pages implementation guide, which tells what are the responsibilities of the auditors in reporting under this clause. As we discussed earlier in the slides, the schedule 3 has got a direct reporting on this, on the asset side, whether I've received funds for this giving to intermediaries and getting back the money, or whether I'm receiving funds so that I can give it to an intermediary for repaying loans. Evergreening, as we call it. So the company also has to report on this, and the auditor also has to directly give a report on this. And the last clause, so this is typically known as the evergreening clause, as we call it. And you have got this clause F, which says whether dividend declared or dividend paid is in compliance with section 123. Now, here the auditors are directly going to report whether dividend paid is in compliance with section 123. Now, whether it is interim dividend or final dividend, whether those conditions are fulfilled. And again, the implementation guide has covered this in detail and also given you illustrative paragraphs as to what do you report when you report under this clause F of Rule 11, whether dividend is in compliance with section 123 of the Companies Act in the sense. Okay, so I think that is the last thing what we have on this Schedule 3 and CARO 2020. And I told the organizers that I will take about 2 hours time on this. And I think he has kept the remaining time for your other standards which were there. Of course, we can first take up the queries which are there.
Sir, one thing, whether this dividend includes the dim dividend?
Pardon? I'm
Whether
getting a lot of
dividend...
disturbance. I think someone's mic is on.
I think it's due to, let me see if there is any. But everybody is mute, sir. I think it's due to weather or something like that. Everybody is mute.
So let me at least stop sharing this. Let me see.
So whether dividend includes dim dividend also?
No, it does not include dim dividend. Because dividend is not covered by section 120.
So there is one query in the chat box that a scheme of amalgamation was pending for approval with NCLT as on 31st March 2022 and was approved before signing of the balance sheet.
Yeah.
Shall we report for the same in the CARO report for the year ended 31st March 2022?
See this amalgamation reporting is not CARO but Schedule 3. It will come in Schedule 3 reporting.
Okay. Sir, I have few queries. To what extent the new disclosure shall be repeated in the CFS?
I'm not getting your voice.
Should I write here in the chat box, sir?
No, I'm not able to hear you.
Okay, I'm writing the chat box.
Because I can get a lot of disturbance. I don't know what is that for.
That I am also having here, but
Anilji, your fan must be on.
No, my fan is not running. I'm in the AC.
Oh.
So maybe I can.
Yes, now it's okay. Yes, and now there is no sound.
Hello, can you hear me?
Yeah, sir, we can hear you.
Yeah, now there is no sound. Yes,
Yes.
please go on then.
Yes, sir. There is one query. Are ratios are to what extent that new disclosures shall be repeated in the CFS?
So in CFS, it's an entirely new disclosure because earlier in CFS, there was no CARO report given. Now in CFS audit also, the auditor has to give a CARO report and he has to reproduce all the qualifications or adverse clauses which the subsidiary or joint venture or associate auditors have given.
Okay.
So he has to reproduce all of those observations in his CARO report of the consolidated financial statements.
So in the balance sheet, whatever disclosure is there, the same as per Schedule 3, all will come in the CFS also.
Not balance sheet, not balance sheet, not balance sheet. We are talking about CARO report by the auditor.
No, so far as the balance sheet is concerned.
Nothing. Balance sheet is concerned, you follow the normal rules of consolidation.
No rules of consolidation. Our ratio is required to be disclosed in CFS.
So balance sheet, you follow the normal rules of. See, in balance sheet, in the financial statement, everything need not be brought from the subsidiaries and all. What is given as a new thing is only on the CARO reporting, which is there.
In case nothing is stated for a particular new clause, because there are so many new disclosures are required to be given in the balance sheet. So if there is something, we have to report on all items or only on the items which are relevant to the company.
So my view is, or our office view is, please report if something is not applicable. Otherwise, the ROC will not come to know whether you have forgotten that or it is not applicable.
Also, we should
And
write
they
it is
may-
not applicable.
Yeah, because otherwise ROC will give you a notice why you have not disclosed this. So it is better to say that we are not disclosing it because it is not applicable.
Not applicable. So one thing, if there is a change in the status of company from large company to small company, whether in this case the company need to prepare this cash flow statement for this year, because there is a change in the definition of the small company.
I have to see the status at the end of the year. If at the end of the year it is a small company, I follow all the concession applicable to a small company.
To a small company, so I need not prepare the cash flow statement.
Yes.
If I was prepare in the last year, I need not prepare this current year.
Correct.
But if there is a change from small company to large company, then I have to prepare for the current year and the previous year also.
Yes, everything would be applicable.
And there is some query from a privately limited company having paid up capital less than 50 lakhs, but sum of the paid up capital and reserves and surplus exceeds rupees 1 crore. Turnover is less than rupees 10 crore and borrowings are also less than 1 crore. Whether what is written there?
So one condition is not fulfilled, no? So CARO will be applicable, no?
The borrowings are less than 1 crore.
But sum of paid up capital and reserve exceeds 1 crore, no?
Yeah, it exceeds 1 crore.
Yeah, so one condition is not satisfied. So CARO will be applicable, no? Then.
But it is a small company.
See, then small company exemption will still be applicable.
It still be applicable, yeah.
Yeah.
If proprietor is in the name of company, then only the chart has to be made in the balance sheet. I would like not understand this query. If proprietor,
where is that query?
From Manish Yaduka, if proprietor is in name of the company at 4 hours 26 minutes, then only then also the chart has to be made in the balance sheet. Property is in the name of the company, but that you have disclosed, you have already stated.
Yeah. So there is, no, I don't see any other query. But you have got other balance sheets which have come now. You can see Infosys, you can see Tata Consultancy Services. You will be very soon able to see Reliance also in a week's or 10 days time. So you will see what is given by most of these bigger companies also.
Okay, so there is no more queries here. So we can proceed to other sub topics which we have discussed.
Yeah, so that topic I have not made a presentation because you had said that there would be a lot of issues in those accounting standards.
that
So
would be the
whatever
interactive
issues you
session.
have, we can discuss them.
You can disclose. You can discuss the requirement of this.
There is a query which has come. Can you?
No such
Yes.
query is there in the
Can
chat
you
box.
please explain return on investment?
नेट का प्रॉब्लम चल रहा है. Sir, what I suggest, if you have not made this presentation, what the relative accounting standard says, and then we have the query from the floor. If there is any query, we will address it. Otherwise, we will close down. There are a lot of internet issues today.
Also, it is going out and coming back again.
Yeah, it's a problem. It's an internet issue, sir.
आगे बोलते ना मैंने करना आता लेट आता है तुम्हारे
हम होस्ट है ना.
Yeah,
Yes,
so
sir.
please go on. How do we proceed now?
Sir, what I suggest you to please go to explain in brief the provisions of as discussed the accounting standard one. What is the AS1 says, what is AS2 says, AS9 and AS10 in brief, and we'll ask the delegates if they have any query. They will raise the query. If they don't have the query,
What are the standards you wanted?
first is
AS1.
AS1. AS1 is accounting policy. So how we have to disclose the notes to accounts. AS2, that is the evaluation of inventories. AS9, revenue recognition, and AS10, property, plant, and equipment.
So AS1 is on disclosure of accounting policies. So that's the basic accounting standard which is there, which says that all your accounting policies, which are material accounting policies, needs to be disclosed at one place. And if you don't disclose that, your financial statements are incomplete. So typically all companies, whether private or public, show what are the basic policies, like which accounting standards they follow. So they will say that we are following accounting standards as promulgated under section 133. What are the judgments and estimates which they are following? What is the revenue recognition policy? What is my depreciation policy? What is my inventory policy, forex policy, employee accrual system? All are these basic accounting policies are need to be given in terms of ES1, which is there. If you do not give them, then clearly you are not following the section 133, and these accounting policies are even required by a partnership firm or even a trust or anyone to be disclosed. Otherwise, your financial statements are incomplete, and even the institute or anyone can hold you responsible that you have not audited or you have not asked the company to put this, and you have still issued an audit report in that sense. So that is really ES1, and ES1 also talks about that all accounting policies have to be consistent. You also need to give say whether previous year and this year the same policy is followed or not followed. If there is any change, along with AS4 and AS5, what is the impact of the change on the accounting policy? That also needs to be disclosed very clearly. And if you are under Ind AS, there is a lot more disclosure to be given, because then for almost each and every standard, you need to give a accounting policy, say for direct tax, deferred tax, then segment reporting, employee benefits. Then what are you doing about cash flow statement? What are you doing about amalgamations? How are you consolidating? How are you following your lease accounting? All those needs to be given. So in a India's company, your accounting policies can itself go to about 10 or 12 pages. But in a non-India's company, it can still become 3-4 pages which are there. So that's really the basis for AS1 in that sense.
So only the accounting policies which are relevant to the company's operation need to be given.
Correct, correct. You don't need to give, say for instance, if a company has no inventory, it is only doing service activity, then I will not give a policy for inventory.
Yes.
That way. But when I give an accounting policy for, say, revenue, I have to give my accounting policy for all types of revenue, like purchase and sales, interest income, dividend income, then scrap income, insurance policy, all incomes which come in, I have to give an accounting policy for that.
So, sir, here in the revenue recognition, accounting policies for other income also to be given.
Yes, everything needs to be given, because everything what you account needs to be given.
Because in Calcutta, many balance sheets we see the revenue recognition, other income part is not given.
No, all that needs to be given. Otherwise, it is incomplete information in that
complete
sense.
Information. So if there is some missed out, say last year, there was no policy was given with respect to.
You include this year, no? No, you just start including this year, no? Then.
So it will not be seem to be a change in the accounting policy. It is not a change in the accounting policy.
No, no, no. You just try and include it this year. That is all right.
That is done. Huh?
Yeah, that is all right.
Okay, sir. AS2 inventory valuation.
So AS2 is on inventory, and in inventory, AS2 says that you need to value inventory. And for valuing inventory, it can be work in progress, raw material, finished goods, or any other category of inventory. And the first basic principle is whether your inventory is at cost or market value. It says that it always has to be at cost. It cannot be at market value. And when you are valuing that at cost, you can either follow the cost principles like first in, first out, or the weighted average cost. Both are acceptable. And it also then goes on to lay principles of in case it is typically it is cost or market value, whichever is lower. So in case the market value of your inventory is lower than the cost, how will you value that at NRV, net realizable value? So in case of finished goods, I will compare my finished goods cost and the finished goods NRV. If NRV is less, I will value at NRV. If it is raw material, I will again consider my cost of raw material, but for that NRV, I will consider after processing that item and making it finished good, is the NRV still lower than my cost? Only then a raw material will be valued at NRV. Otherwise, raw material is normally valued only at cost. So a very important principle on valuation, because even income tax authorities look at this very closely, whether cost or NRV is taken or not taken. And when you do this cost, it is to be done at absorption costing. You have got fixed overheads and variable overheads. So fixed overheads are on absorption costing where there is normal level of production. Variable overheads are to be absorbed based on the actual production, but the fixed overheads are to be absorbed based on a normal level of production which is there. And these principles again are followed by almost all companies, and the disclosure given of the policy which is followed by companies for this.
So what are the common errors which we find in the balance sheet, sir?
The FRRB has given a list of all common errors which are there in AS2. One is even writing cost or NRV, whichever is less. They sometimes write cost or market value, whichever is less. You have to write NRV, not market value. So FRRB has a very big list of such common errors which are observed in the AS2 compliance or even in AS1 in that sense.
Sometimes they do not also write a formula also, whether it's a FIFO method or weighted average cost.
Correct. So that needs to be written whether you
This
are
also we have
following
seen in
first
many
in,
balance
first
sheet, it
out,
is
or
not written there.
weighted average. Correct.
And
Correct.
then you have to give this valuation formula for all category of stock, like raw material, finished goods, scrap, work in progress, everything has to be given. How
Yes,
you have
that is
valued
right.
each item of inventory.
Everything has to be given. That is right. For everything, the formulas have to be given.
And should we also write what does the cost include?
No, normally you don't need to include because that is there in the standard only, because it will include all direct overheads. It does not include indirect overheads.
Yeah, that we need to write in the policy, in the statement.
No,
That
it
the cost
is no, that you don't need to write in the
Not-
policy. It is
not
normally included in the standard itself.
okay. And the third one was accounting standard for revenue recognition.
So revenue recognition, the standard is how do you recognize revenue? So basically the principle is risk and reward concept. So you recognize revenue when the risk and reward has been transferred. So the risk has to be transferred to the customer and the reward has to be transferred to the company. Only then I can recognize revenue. So if I have sold goods on, say, export sale, the goods are still lying with me. They are not sent out on a ship or something, then I cannot recognize revenue because the risk is still with me and the reward is also not received by me. So I will be able to recognize revenue only when the bill of lading is made, not necessarily when the goods leave my factory in that sense. So risk and reward is the criteria which we use, and depending on whether your invoice is CIF, whether it is X works, whether it is FOB, whether it is X delivery, it would depend on whether the risk and reward is transferred. And the accounting policy which someone discloses or a company discloses also says the same thing, that revenue on sale of goods is recognized when the risk and reward is transferred. Risk is transferred to the customer and the reward is transferred to the company. If you have sales which are recognized, you will have to reverse it and show it as inventory if the risk and reward has not been transferred to any other customer.
And sir, last one was property, plant and equipment, AS10.
So that is AS10. I think that's a very basic standard that all your capitalization on property, plant, equipment, how does it happen? So again, you take all direct expenditure of the asset and all direct expenditure to bring the asset to its current location and condition. All that can be capitalized and it should be in the manner capable of being used as intended by the management. Till that day, all expenses can be capitalized by the company and depreciation starts from that particular date which is there. In case there are delays and there are items which are delayed, then you will have to stop capitalization in between, but only direct expenditure can be capitalized, like the machine cost, the transportation cost, the installation cost, and so on. Expenses like sales expenditure or selling expenses and all cannot be capitalized. The standard also talks about what happens if you carry on repairs to that asset. And AS10 really says that in case the asset goes to a capability which is increasing the capacity of the asset, then only I can capitalize something further. Otherwise, the other expenses will normally be in the nature of repairs which are there. Then AS10 also talks about whether I can do a revaluation of the asset. I can do a revaluation of an asset of a class of assets based on some revaluation methods. And as we discussed in Schedule 3, if you do a revaluation, you need to disclose how are you doing a revaluation, whether it is a approved value or not approved value or and so on. And finally, the standard also talks about depreciation of of a tangible asset, the methods of depreciation. Typically, it talks about the life of an asset, depreciate over the life of an asset. In India, we also have the Schedule 2. So you can follow either the Schedule 2 or the life of the asset, but Schedule 2 give you the minimum rates. The life of the asset, as per the life of the asset, you can provide higher depreciation, but you cannot provide lower depreciation than the Schedule 2 rates which are there. And the standard finally talks about in case you dispose a asset, how do you calculate the loss or profit on sale of that asset, and that the profit and or loss will have to go to the profit and loss account whenever you dispose of or take the asset out of existence or something. And this standard is very closely linked to your CARO reporting on whether you have a fixed asset register or how do you maintain a fixed asset register, which is there. But a very basic standard, and everyone knows this standard, in fact, quite well, because in income tax also, this is very commonly a disputed thing, whether capital, revenue, and so on. And that is what this standard really talks about.
Also, where in case if you the management takes into account the life of the assets higher than the as is disclosed in the schedule 2, then one has to report. No?
Yes. Yeah, report means you have to only write that based on your technical evaluation, I have taken a life which is higher than schedule 2. That is all
But you
have
cannot
to
have a lower than that.
Normally, no. But some companies also take it lower based on some technical evaluation.
Okay. And now we raise some, if the delegates have any query on these accounting standards or schedule 3 or CARO, you please ask, unmute yourself, and you can ask your query on your own. In the chat box, there's no. Can you explain return of investment with example? I don't think this is the forum where we should ask for this thing.
No, but this is accepted thing. No, the guidance note has given what is numerator and denominator.
So the institute has come up with the guidance note on schedule division 2.
No, it is there on division 1 and division 3 also.
Also, na? But
all three are there.
All three are there. Na? So one query which I wanted to ask, but I forgot, whether in respect of each of the new clauses, whether you have to give the previous year's figure also.
Yes, as far as possible, you have to give the previous year figure also.
As far as possible, na? If this is not available, like you said in the case of the CARO reporting, so we are not taking the...
CARO does not need previous year figure, only schedule 3 needs previous year figure.
Yeah. Okay. So in the schedule 3 also is reporting on the bank borrowings. So if the previous year's figure are not there, we can still...
Yeah, that you can avoid, but say on this trade receivable aging and all, you will need to give previous year figures.
Okay. Okay, sir. Thank you, sir, from my side. So I think there are no much queries here. So I think it's a time to close it. No further queries raised by the delegates.
Yeah, it is a Saturday evening, so we can close a bit early.
But sir, can you vote of thanks? Okay, sir. I am giving the vote of thanks on behalf of our association. Sir, you have brilliantly, let me tell you, have in blended both the schedule 3 and CARO. आपसे जब बात हुई थी आपने कहा था मैं दोनों को साथ में लेके कवर कर दूंगा. I was a bit perplexed how it can be covered because schedule 3 और CARO दोनों अलग-अलग चीजें हैं, लेकिन आपने दोनों को बहुत ही अच्छे से एक दूसरे के साथ में ब्लेंड करके आपने इसके ऊपर डेलिब्रेशन किया है. And the deliberation has been really very, very detailed deliberation. I don't think we have missed out anything because we have attended other seminars also. दोनों के अलग-अलग सेमिनार अटेंड किए हैं, उसमें भी सारी चीजें कवर नहीं कर पाते हैं और कर पाते हैं, ऐसी बात नहीं कर पाते हैं, बहुत टाइम लगता है, पर लेकिन 2 घंटे के अंदर में आपने दोनों को बहुत ही ब्यूटीफुली ब्लेंड किया है. एंड इनफैक्ट हमारी बहुत सारी क्वेरी थी जो मैंने सोच रखी थी मैं पूछूंगा. Everything you have covered in your presentation also. So thank you very much, sir, from the core of my heart and on behalf of my association. And I request all the delegates who are here to have a huge round of applause for Himanshu sir. And thank you, sir, very much. And in future also, we look forward to listening from you on the subject. Thank you, sir.
Yeah, thank you. My pleasure.
Time, sir. Thank you, sir.
My pleasure. Yeah.
Last time आपको सुनना था लेकिन आपके फ्लाइट के साथ में गड़बड़ हो गई थी.
I know, I understand. I was traveling or I just could not take it that time.
Yeah, जो आपको फ्लाइट थोड़ी सी वो हो गई थी बाद में तो उसके काम हो नहीं पाया था.
Correct.
Thank you, sir. Thank you very much.
All right. Yeah. Thank you. Namaste.